Hey everyone, welcome back to Corporate Decoder. Today we are diving into a report from Invesco, a big investment company. It looks like they are playing with billions of dollars and hopefully not losing them. We are here to see exactly what they are up to. Before we jump in, if you're into understanding what's really going on behind the scenes in the business world, be sure to subscribe. Also, come join our Discord channel. The link is in the description below. This report is called an 8K, and it's basically a quick update companies give when something important happens. The date on this report is May 16, 2025, so it's pretty fresh news. The main thing in this report is that Invesco got into some new big agreements. It looks like they made a couple of deals for loans and credit. These are serious financial arrangements, so let's dig into what they mean. First up is a term loan agreement. This is basically a deal where Invesco, through one of their smaller companies, Invesco Finance, borrowed a total of $1 billion. They got this money from a group of banks and other lenders. Think of it like taking out a huge mortgage, but for a business. So what did they do with all that cash? Well, it seems Invesco used the loan to buy back some of their own stock. Specifically, they bought back $1 billion worth of something called preferred stock from a company called MassMutual. Buying back stock is often seen as a way to boost the stock price because it reduces the number of shares available. Invesco also paid MassMutual a premium, which means they paid more than the stock was originally worth. In this case, they paid 15% extra, so MassMutual made a nice profit. Now, about that loan, it's split into two parts. A $500 million loan that needs to be paid back in 3 years, and another $500 million loan that has a 5-year term. The 5-year loan requires them to make smaller payments every quarter, starting 3 years from now with the rest due at the end. Invesco might even increase the loan amount to $1.5 billion under certain conditions, but the lenders don't have to agree to it. Of course, Invesco has to pay interest on these loans. The interest rate is based on something called term SOFR plus a little extra depending on how risky the lenders think Invesco is. SOFR is basically a benchmark interest rate, kind of like prime rate, but for bigger financial deals. There are also some rules Invesco has to follow as part of the loan agreement. These rules, called covenants, are designed to protect the lenders. For example, Invesco can't take on too much debt compared to their earnings, and they have to keep a certain level of cash coming in to cover their interest payments. It's like having a budget and sticking to it, but for a massive company. The loan says that Invesco needs to maintain a debt-EBITDA ratio of less than 3.25 to 1. This ratio basically measures how much debt they have compared to their earnings. They also need to keep their interest coverage ratio above 4.1 to 1. The term loan agreement also specifies what happens if Invesco messes up. These are called events of default. If they don't pay on time, break the rules of the loan, or go bankrupt, the lenders can demand their money back right away. There's even a clause that says if Invesco defaults on other loans, that can trigger a default on this one too. This part isn't interesting as much as it is important, so don't fall asleep. Next up is the credit agreement. This is like a credit card for the company, but on a much larger scale. Invesco and another one of their companies, Invesco Finance PLC, have a deal for $2.5 billion with a group of banks. They can borrow money as needed up to that limit. This new agreement actually replaces an older one, increasing the amount Invesco can borrow. It gives them more financial flexibility. They can use this credit line for all sorts of things like running the business, investing in new projects, or just keeping things running smoothly. The credit agreement lets Invesco increase it to $3 billion if the banks approve. Like the term loan, the interest rate on this credit line is based on SOFR, plus a bit extra depending on Invesco's credit rating. They also have to pay a fee on the amount of credit they haven't used. This credit agreement also has rules about what Invesco can and can't do, like not taking on too much debt or selling off important assets. They also have to keep their finances in good shape. Just like with the term loan, again, Invesco needs to maintain a debt-EBITDA ratio of less than 3.25 to 1 and keep their interest coverage ratio above 4.00 to 1. And just like with the term loan, there are consequences if Invesco breaks the rules. If they default on the credit agreement, the lenders can demand their money back and take control of the situation. Alright, that's the gist of these two agreements. It's a lot of financial jargon, but basically Invesco borrowed a bunch of money to buy back some stock and has a credit line they can use for general business purposes. Now, what does all this mean? On the one hand, Invesco is taking on more debt. That can be risky, especially if the economy slows down or if their business hits a rough patch. On the other hand, they're buying back their own stock, which can boost the stock price and make investors happy. Also, taking on debt is a smart move to maintain a strong balance sheet. However, it makes it more vulnerable to market instability and interest rate hikes. Overall, Invesco seems to be making some bold moves to try and improve their financial position and reward shareholders. But like any big financial decision, there are risks involved. It'll be interesting to see how this plays out in the coming months and years. Alright, that's our breakdown of Invesco's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.